So today we're going to have a first look at financial statements. And we're working from this book here, SACE 2 Accounting Studies 1, Financial Statements, Part B, the Income Statement. And put your accounting assessment goal for the year in here, what you would like to achieve for this section, Part B, for income statements. And let's have a look at the model income statement. Here it is. I'm just going to zoom out a little bit. We've seen this before briefly. Let's have a look at the headings. We've got revenue up here. We've got net sales, then cost of goods sold. We've got that cost of goods sold figure there. We've got gross profit, less operating expenses. Then we've got selling expenses, admin expenses, finance expenses, and down the bottom here, non-operating expenses, total expenses, and the bottom line is the profit. If anyone says, what's the bottom line? That's the profit, and there it is. Okay, so that's the general outline of the statement of income, the model statement of income. Let's have a look at this and break this down a bit. First up is net sales. We've got revenue, and from this revenue we want you to arrive at net sales. Here's our revenue here. It's a heading. And under revenue, we have our two major sources of revenue, and they are, in this instance, it's a trading company. They are cash sales and credit sales. And we can see here, cash sales are about 3 times the credit sales. You will find in the workplace right now that credit sales would probably be greater than cash sales. They've been increasing while cash sales have been decreasing. But we record both. And we need to know our credit sales because that is important later on. We sum those both up here in that column over here, and then we deduct 2 items in this instance. Less sales returns. So when we make some sales, invariably, if you make lots of sales, we're going to have some come back. We're going to have some sales returns. And so after we've made those sales, and then people bring some stuff back, we have to refund that amount, and so we can't count that amount. We have to deduct those sales returns. So here we are, we less the sales returns. Also, you might offer some discounts. Sometimes you might have a sale, but that will probably go through as under the sales or credit, would be less that amount, but you might offer people a discount for paying early. For example, paying within 10 days or something like that. So you'll make a sale, but if paid, might be a credit sale, and if you pay your sale within 10 days, you may get a discount on that. And so that discount allowed is monies that we never received and we never will. So we're going to deduct that from our sales revenue. And here we have the total, the subtotal of those amounts, the sales returns and the discounts allowed. Just some small points here. Notice over here we say less sales returns and less discounts allowed. When you write that there, we can put over here just the amount. You don't have to put a negative sign, or you don't have to put it in brackets. Of course, in brackets, in accounting terms, that denotes a negative figure. This second column here, though, it's a third column, where we have subtotaled our amounts we're going to deduct, it doesn't have a heading, less discounts or less sales returns. It doesn't have less subtotal of those amounts deducted. It is a negative figure. It's going to be subtracted from our total sales here, total revenues. And so we'll put it in the brackets just there. That's a good practice. And this figure here is our total sales minus those deductions, gives us our net sales. There, that is there. Sometimes you may not have the heading here, net sales, and this figure may be just up here as a subtotal. So there is our total sales. This is the majority of the revenue that's going to come into this trading entity. Next, we're having a look at the cost of goods sold. So when you have a trading entity, that's when you trade in goods. And when you trade in goods, you have to deduct the cost of those goods from the sales, and that'll give you your gross profit figure. In a service industry, the service business, you will not have goods. You will not have to calculate this cost of goods sold. But in a trading entity where you have goods, you will. And so just the fact that you've got this cost of goods sold denotes the fact that this is a trading entity. We're trading in goods, not services. And the cost of goods sold, we calculate this. We begin with our opening inventory. Okay, how much stuff did we have at the start of the period? And then we're going to add all our purchases of goods. Okay, so here we're going to add in our purchases for the period. That will equal or give us the cost of the goods that we had available for sale. Starting inventory plus all our purchases. That gives us the cost of goods available for sale. Now then, we want to deduct what we had left over at the end of the period. That is our closing inventory. So take away your closing inventory, and that gives you your cost of goods sold. So there's no figure anywhere that just says, hey, the cost of the goods sold is this. We have to do the calculation. Again, everything we start with, our opening inventory, add in our purchases for the year. That gives us the total value of everything we had available for sale. Take out what we had left at the period, which is our closing inventory, gives you your COGS. And so we might find it represented like this in our income statement. Cost of goods sold is equal to opening inventory. There it is. We're going to add in our purchases. So we made $125,000 worth of purchases. And then we're going to deduct off these two items here. Purchase returns. So some of the goods we had in, they weren't what we wanted. They were faulty for whatever reason. We're going to return them to sender. And so we're going to deduct those from our purchases right here. We may also get a discount for paying for our purchases early. Okay, our invoice, we may purchase these on credit, and if we pay within 10 days, we might get a small discount. And so if we get that discount, if we receive that discount, we're going to deduct that from the value of the purchases. We never paid that for our purchases. So right here, we're going to deduct these small amounts, less purchase returns and discounts received. And this figure here is a subtotal of purchases less discounts received. And then we continue to add up the cost of the goods sold. These three items here, these get added to the cost of the goods sold. These aren't actually the direct costs involved in purchasing, but they're not the cost of the goods. The purchases is the cost of the goods. Here, we're adding any cost associated directly with getting those goods in and preparing them for sale. So let's have a look at the examples we've got here. Buying expenses, bit of a general catch-all. Cartage inwards. Cartage, freight inwards, synonymous, an older term. Cartage in, to cart something around. If to cart those goods in, that cost gets added to our purchase cost as part of our goods, the cost of the goods sold. So too, customs duties. If we import something, we're going to have a customs duty when it comes through customs, and import duty. And so that is a direct cost of getting our purchases, the products in and getting them ready for sale. What could be involved in getting them ready for sale? Maybe unpackaging. Maybe get bicycles in from China. They're in a big cardboard box. You've got to assemble them. So there might be assembling costs, those kinds of things. So getting them ready, getting them in, and getting them ready for sale. They all come under the cost of goods sold, okay? Very important. And here they are there. And so our purchases less the small discounts received and the purchase returns, add in our buying expenses. This gives us our cost of goods available for sale. Then we deduct the closing inventory. Here it is there. And that gives us our cost of goods sold. Too easy. Beautiful. After that cost of goods sold, we might have some, that'll give us, we might have some other profit from sales. Those sales revenue who we had above, they will be from ordinary operating profits. Okay, we've got net sales, We've got less cost of goods sold, gives us our gross profits from sales. Now, we may have some other revenue generated through the period that wasn't from the ordinary course of trading. For example, interest revenue and rent revenue. We may rent a small portion of the warehouse out to the neighbours or someone else, maybe one of our customers, and we may get some small revenue from that. Interest on some outstanding debts, perhaps. Some of our debtors, they may be late in paying, they may incur an interest charge, and so we may generate some interest revenue there. It's not part of our normal operations, but so therefore we put it under this heading of other revenue. Interest revenue, rent revenue, subtotal there of those two revenues, and then we add that revenue there to our gross profit from sales to give us our gross profit figure. And there it is. Then we're going to deduct our operating expenses. Most of our expenses will be, in the normal course of operations, will be operating expenses. Sometimes we call it operating expenses because of our operations. Most of our expenses are operating expenses. You may not call them operating expenses. We may simply call them expenses, but they are operating. And here we are. We are going to have about three headings: selling expenses, administrative expenses, and financial expenses. Let's have a look at those selling expenses. These are directly related to selling. Let's have a look at them. Commission expenses. If you've got commission salespeople, commission expenses directly related to selling. Advertising expenses. Yes, to sell those goods, we're going to incur advertising expenses. Cartage outwards. When we sell those products, we're going to deliver them to customers. Delivery expenses, other expenses involved in delivery. And so we're going to sum all those together, and they're our selling expenses. Selling expenses can be variable. They can vary with the volume of sales we might have for the period. If we have a boomer, a bumper of a period for sales, our selling expenses will also increase directly proportional with our sales. If we have a poor selling period, our selling expenses will be less. So our selling expenses tend to be variable proportional to the volume of sales for the period, as opposed to administrative expenses. These are general in nature, but they tend to be more stable. For example, wages. You've got X amount of people, each period you may have the same amount of wage expenses. Office salaries, electrical expenses, telephone, council rates, general office expenses. Most of these expenses are going to be pretty stable through the accounting period. And so that's one way to sort of identify or to tell if an expense is likely to be administrative or not. Recognize those. And then there's financial expenses. A couple of financial expenses. Interest expense is a finance expense. Bad debts is a finance expense. So some of our debtors, they don't pay, we write them off. That's considered a finance expense. After that, after our operating expenses, we are going to be focusing on those three operating expenses: selling, admin, and financial. We have non-operating expenses. For example, loss on the sale of furniture. If we sell some furniture and it's less than our carrying amount, our book value, then we'll record that loss right here. Another loss we might record here could be loss from theft or just loss of stock. Okay, non-operating expenses. And that gives you your profit, your bottom line profit. Gross profit less your total expenses gives you your profit. Okay, and that's how we arrive at a profit. There's an overview of the income statement, so become familiar with that and know how to differentiate out all those different costs and expenses, our revenues, and other operating revenues and other non-operating expenses. We need to be able to classify each individual expense so that we put them in the correct category in our income statement.